Hello, everyone, and welcome. I'm Tom.
And I'm Amy, joining you for another exploration of the insights that matter most.
We've got some really timely material today. You sent over the EXANTE quarterly macro insights for Q2 2025, just out yesterday, actually.
That's right.
So our plan is to unpack all that information, what happened in global markets from April to June, and then try to look ahead, see what might shape things in Q3.
Precisely. We'll try and distill the really crucial takeaways from those surprising market rallies we saw to shifts in the geopolitical scene, just trying to get a clear picture of what happened and, importantly, why it matters for the next few months.
Okay, sounds good. So let's start with the U.S. market story, because Q2, well, it really felt like a tale of two halves, didn't it?
It certainly did.
It ended up being a great quarter for U.S. equities, which honestly is pretty remarkable given some of the headwinds everyone was talking about. The S&P 500 and the NASDAQ 100, they both hit new all-time highs.
Yeah, and what's really fascinating there is how quickly things turned around from those April lows. Remember all the jitters
Oh, yeah?
around the president's new tariffs, the Liberation Day tariffs, as they were called? That seemed to force a pause, almost, in trade talks.
Right.
But despite that, the S&P 500 recovered really strongly. It ended Q2 up almost 5%.
And it wasn't just a quick bounce back in April. May and June were exceptionally strong. I mean, the S&P 500 saw its best two-month return since, December 2023? Something like 11.7% total.
Exactly. Investor fears really seemed to calm down. You saw the VIX, the fear gauge, drop quite a bit from its peak.
Yeah.
And, despite those earlier worries, maybe back in January, about things like DeepSeek potentially disrupting big tech, well, AI companies just kept climbing.
They really did.
NVIDIA, for instance, up almost 17% just in Q2. It just signals that continued strong investment in efficiency and innovation, that really drove performance, especially in information technology and communication services.
That tech performance was definitely a highlight.
Yeah.
IT led the way, like you said, in communication services. Energy actually saw decent gains, too. But on the other side, you had the more defensive sectors, like consumer staples. They lag behind. Real estate dipped a little bit, too.
Right. And the Magnificent Seven? Mostly positive again, though. Tesla was the exception there. Noticeable drop for them.
Yeah, saw that. But here's something really interesting. Even with all that tariff uncertainty hanging over things, the S&P 500 still managed average earnings growth of, 13% for Q2.
It's quite something. And it raises that key question, doesn't it? How are companies managing to maintain that kind of profitability?
Exactly. What's happening with the margins?
Well, the estimate suggests the net profit margin for the S&P 500 in Q2 was around 12.3%. That's actually slightly above last year's margin and also above the 5-year average. Communication services, like we mentioned, they're expected to see a pretty significant jump in margins, whereas energy, maybe some declines there. So it suggests, some industries are adapting really well, others are maybe feeling the pressure a bit more.
Right. Okay, let's shift gears a bit. What about bonds? That seemed like a more mixed picture in Q2.
Definitely mixed. You saw shorter-term Treasury yields, they actually declined. And that was mostly driven by rising bets that the Fed might cut rates again, maybe in September.
Okay, so the thinking is shifting there.
It seems so. After being on pause, some of the softer economic data, especially around consumer spending, seems to be nudging expectations towards a potential cut later this year.
But the longer end of the curve was different.
Yes, that's a really key takeaway. Longer-term rates continued to push higher, and this highlights those growing concerns about U.S. fiscal policy, debt sustainability, especially with talk about that potential big, beautiful tax bill adding trillions more to the debt.
Right, that's definitely been in the headlines.
And that upward pressure, it pushed the 30-year Treasury yield up above 5% back in May. That's telling you bond investors are demanding more compensation for holding that long-term uncertainty.
Okay, that makes sense. Now, what about the U.S. dollar? Because that had a really volatile Q2, ended down over 7% against a basket of currencies. I read that's its worst start to a year since, 1973.
Wow, yeah.
So what's behind that sharp drop? What does it all mean?
Well, if you connect it back to what we were just discussing, the dollar's weakness seems tied to a few things. Those ongoing tariff uncertainties, the fiscal policy worries, plus the rising expectations of Fed cuts, and maybe some early signs the U.S. economy is weakening a little.
Okay.
And that has a direct impact, obviously, for you listening if you hold international investments. A weaker dollar boosts the returns on those when you convert them back.
Right.
We saw the euro, for instance, gain quite a bit against the dollar, hit its highest level since 2021. The British pound was strong too. The Japanese yen, though, that moved the other way, weakened against the dollar.
Interesting divergence there. Okay, beyond currencies, commodities also saw some big moves. Gold, for instance.
Yes, gold has been striking, up over 27% year to date. And what's fascinating here is it doesn't seem to be just, speculative market froth.
Right.
It seems primarily driven by a real structural increase in demand from central banks. Their gold buying has apparently increased fivefold since 2022.
Wow.
That trend really picked up after Russia's central bank reserves were frozen. And there was a recent Goldman Sachs survey that confirmed it record high buying intentions and basically no central banks planning to reduce their gold holdings.
So it's a strategic shift.
It looks like it. Maybe fueled by those wider worries about fiscal debt, maybe tariff shocks adding to inflation concerns. Gold as a hedge.
Okay. Now, on the flip side, oil prices actually saw declines in Q2, didn't they? Even though we had that flare-up in tensions between the U.S. and Iran in June.
Yeah, that was interesting. There was an initial spike, as you expect, but then prices dropped quite significantly afterwards. West Texas Intermediate crude, I think, fell nearly 9% for the whole quarter.
So why wasn't the geopolitical risk priced in more?
Well, it raises that important question about how markets interpret these events, right? Iran's response to the U.S. actions was seen by the market as, well, de-escalatory. The missile attacks were largely symbolic, seemed designed to avoid casualties.
Oh.
So markets kind of read that as a signal that neither side really wanted a wider conflict right now. Of course, the focus remains on the Strait of Hormuz. That's the critical choke point.
Always.
A sustained blockage there would absolutely cause prices to surge. But for now, it seems the market is pricing in maybe a persistent, moderate risk premium rather than anticipating a major supply disruption.
Got it. Okay, let's look internationally now. Europe. Equities there seem to have a tougher time in Q2 compared to the U.S. Quite a contrast to their strong Q1.
That's right. They underperformed. Most of the major European indices finished the quarter down.
But earnings are still expected to hold up.
Apparently so. Earnings for the SDOXX 600 are still projected to increase year over year. Technology, again, showing strong growth there too. And the ECB, the European Central Bank, they continued cutting rates in Q2, signaling they want to support growth, though they might pause in July, perhaps waiting to see how tariff talks play out.
Okay.
And the UK.
Well, the Bank of England cut rates back in May, then held steady in June, but the jobs market there is weakening, which makes another cut maybe in August seem more likely. Interestingly, even though GDP fell back in April, consumer confidence actually ticked up a bit in June, maybe a slightly more optimistic view starting to emerge.
But they have fiscal challenges too, right?
Yes, that's an important point. The UK government is facing a potential budget hole, mainly because they reversed some planned policies, like certain welfare cuts. And that's put pressure on UK government bonds, the gilts. Yields have risen because the government might need to find other ways to raise money now. Right, makes sense. Meanwhile, Asia ex-Japan seemed to have a really strong Q2.
Yeah, they did very well. A couple of tailwinds helped there. The falling U.S. dollar was a big one. And also that temporary trade agreement between China and the U.S. seemed to boost sentiment.
So the index reflected that.
Absolutely. The MSCI Asia ex-Japan index was up, 12.7%? Pretty robust. And you even saw Hong Kong's Seng index rally quite strongly, showing better sentiment towards China, at least for a while.
Okay. And quickly, before we look ahead, what about crypto? Big swings there, too.
Huge swings. After that sharp fall in Q1, crypto markets recovered quite significantly in Q2. Bitcoin was up over 30%, Ethereum over 36% for the quarter.
What drove that rebound?
Well, what's fascinating there is it seems largely fueled by two things. Increasingly positive, or at least crypto-friendly, noises coming from the Trump administration.
The policy angle.
Exactly. And alongside that, those rising expectations of more Fed rate cuts, which tends to help risk assets generally. Plus, Bitcoin saw really strong support from institutional investors buying those spot Bitcoin ETFs. Billions in net inflows just in June.
So real money coming in.
Yeah. Apparently, it was Bitcoin's and Ether's strongest Q2 performance since that big post-COVID rally back in 2020.
Wow. Okay, so that sets the scene. Now, looking ahead to Q3 2025, what are the key things we need to think about? And I guess the elephant in the room is tariffs, right?
Absolutely.
The U.S. president's new tariff regime feels like a really significant inflection point. The average U.S. tariff rate is now over 15%, apparently the highest since 1936. I mean, what does that signal for the economy?
Well, historically, tariff hikes like this are usually seen as stagflationary shocks,
Meaning,
meaning they tend to do two things at once. They raise the probability of an economic slowdown, and they put upward pressure on prices, on inflation.
right, slow growth, higher prices, not ideal.
Not ideal at all. And while, a full-blown U.S. recession hasn't actually happened yet, the anticipation of higher inflation from these tariffs suggests we might see interest rates stay higher for longer, even if the market is pricing in rate cuts.
So the Fed might be more cautious than the market thinks.
It seems likely. Despite growing pressure, they'll probably want to remain pretty cautious until the inflation picture is clearer.
And we're seeing this weird disconnect now, aren't we? Between like the soft data confidence surveys bouncing around with every tariff headline and the hard data like jobs and actual inflation, which seem more resilient so far.
Exactly, that disconnect. But it raises a crucial question about the real-world impact down the line. We're already hearing that tariff uncertainty is starting to translate into lower spending, both from companies and consumers.
How so?
Well, companies are apparently delaying investments, reevaluating supply chains. We're seeing tourism is basically in a recession, the housing market is softening. And then on the supply side, any sector that relies heavily on foreign supply chains, they face obvious headwinds. That could really start to pressure corporate earnings and profit margins in Q3 and beyond.
And globally, the U.S. is such a big engine of demand.
Right. Given the U.S. is a net contributor to global aggregate demand, higher U.S. tariffs are generally expected to slow down global GDP growth, too. It's just a very different setup from, say, the 1940s when U.S. tariffs were also high. But the U.S. had a massive trade surplus because it dominated global manufacturing. Not the case now.
Okay, so tariffs are huge. What else is on the radar for Q3?
Well, beyond just monetary and fiscal policy, there's a really packed calendar of events that could easily move markets. Geopolitical tensions, for one, they remain pretty high, even with some ceasefires here and there. So traders will be watching, obviously, the outcome of any further tariff negotiations, any news on that U.S. tax bill, and especially how all the central banks try to navigate this tricky balance.
Between inflation risks from tariffs.
And those emerging signs of economic weakening.
Exactly.
And there are specific dates to watch, too.
Oh, yes. Quite a few. July kicks off pretty quickly with the BRICS Plus Summit, then the Ukraine Recovery Summit, followed by the G20 Finance Ministers meeting. There's also a parliamentary election in Japan, and then key central bank meetings.
Yeah.
ECB, the Fed, Bank of Japan all meet towards the end of July.
Busy month.
Then August, you've got the Bank of England meeting, closely watching that jobs data. And September's packed again. The UN General Assembly and another round of central bank meetings, ECB, Fed, Bank of England, Bank of Japan. It's definitely a busy quarter for investors to track. Wow, okay. That was quite a comprehensive look at Q2 and definitely a crucial preview of Q3. From the resilience of U.S. tech that we talked about to the really significant impact of these new tariffs and the whole shifting landscape for currencies and commodities.
Yeah.
There's certainly a lot for us to keep an eye on.
Indeed. It's that ongoing interplay, isn't it, between fiscal policy, central bank decisions, geopolitical events. It's all going to be critical. And the information you shared, it really highlights just how interconnected everything is in global markets. Understanding these nuances, well, it can be pretty powerful.
So thinking about all this, what does it mean for you as we move into the second half of 2025? I guess maybe the biggest question is how you see these tariff policies playing out and thinking about what the ripple effects might be on your own financial outlook.
Yeah.
Definitely something to chew on. Thank you for your attention. You can subscribe to our podcast if you like it.
See you next time.